Hello, everybody, and welcome to this webinar from Curo Compensation. My name's Ruth Thomas, and I'm a senior consultant and founder here at Curo, and I'm going to be taking you through this webinar today. It's great to see so many of you on our session today. We run regular webinars here at Curo covering best practice and also some sessions focusing on how our compensation management solution can support you in the reward challenges that you face today. But today's session is a best practice webinar focusing on pay, productivity and performance, and also focusing on how to optimize compensation spend. We ran this webinar back in March this year, but we've had many requests to rerun it, so I've updated it. I know many of you are looking ahead to planning and budgeting for this coming compensation review season. So hopefully today's content is timely and it will give you some good food for thought. So in terms of our agenda for today, I'm going to start with some brief housekeeping and introductions to Curo, and then move on to the topic for today, pay, productivity and performance. And then at the end, we'll allow some questions. So just to start from a housekeeping perspective, you are all on mute. And the session is quite short. We keep to the 30 minutes, so I will move through the topic and the subject matter, and then I'll let you know when we're going to open it for questions at the end. In order to submit a question, if you want to do one during this session, you can use the chat box at the top of your screen, hopefully in the Join Me panel, so there's a little speech bubble, and you can type in your question there. If you don't want to type your question in, you can submit that afterwards. So you can either do that to Carol, who I think helped to arrange the webinar with you, or through our website and the info@Curo functionality there. We are recording this session, so you can request a link to that, but we normally publish them on our website and I share them through LinkedIn, so you should be able to access a replay of this webinar that way. And if you wish to have a PDF of the subject matter, the PowerPoint that I'm sharing with you today, you can also email in to request that. So that's all the housekeeping. So as I said, I'm going to start with a very brief introduction to Curo and who we are and what we do. Just two quick slides. So you can see myself there, Ruth. I'm the industry principal here at Curo, and supporting me on today's call is Mark, our pre-sales consultant. And we're an HR technology provider, for those of you that don't know what we do. And we have a compensation management platform that helps leading organisations to automate, streamline and enhance their compensation processes. We're a best of breed provider, so we only focus on compensation management, and therefore we integrate with many different HRIS solutions and many different talent platforms, and because we focus on just doing compensation management very well. We have over 50 clients across 130 currencies in 140 countries, so it's definitely a global and multinational solution. And we have a growing list of partners through who we work with for implementation and also to extend our sales reach globally. And whilst many of our initial clients were in the legal and financial sectors, our reach now has wide industry coverage, and our solution is definitely agnostic in that regard. And you can see an example of our strong and growing client base here. So a number of names hopefully you'll recognise. And if you'd like to find any more information about Curo, our platform, case studies about how we work with our clients, then you can find a lot of that information on our website. Or if you'd like to see a demo of the system, you can request that there. Or please do get in touch after this session. We'd love to hear from you. So on to today's subject, pay, productivity and performance. So I'm going to focus on pay, and it's linked to productivity and performance. Employee compensation, as we all know, is a significant expense for most companies, so it's really important to get it right, especially when compensation budgets will remain tight in 2017 and 18 for many of us. And the reality for most employers through this year end is that the pay pots will not increase, but recruitment will continue to be challenging and hanging on to key talent even harder. And a lot of those key challenges that we're facing are focused around these three key areas. So issues happening in the economy and politics, issues happening in legislation, and also how traditional practices of performance management and performance-related pay are being challenged. I'm going to take a brief look at each of those areas. So starting with the economic outlook and some few key headlines. Well, for the UK and the US, the median pay growth in the private sectors is hovering around the 2 to 2.5% mark. And managing pay differentiation, I know, with such small pay budgets for merit and salary awards is really a challenge. And we know that from working with many of our clients. Wage growth, unfortunately, remains sluggish, completely contradicting traditional economic models that high levels of employment should lead to higher levels of wage growth. We also have this issue of inflation outpacing wage growth on both sides of the Atlantic, in the US and the UK. So in the UK, the June inflation rate fell unexpectedly for the first time in 9 months to 2.6%, but household budgets still remain under pressure from falling real pay because inflation continues to outpace wage growth, which in the same time period was at 1.8%. So we're going to continue to see this squeeze on real pay, real wage growth, and employers really finding it hard to find any benefit from the pay increases that they receive. I've mentioned low unemployment. So looking at the UK, we reported the lowest unemployment rate on record in May at 4.5%. But from an employer's perspective, this really translates to pressure on talent acquisition. And what we'll probably see is more inflationary pressure on hiring costs and retaining your key talent, which means spending your pay budgets wisely is even more important. The other economic challenge from a human capital perspective is low productivity. I'm sure many of you have read about this. It's been widely commentated on. And in July, it was reported that the UK productivity fell by 0.5% in the first quarter of this year, leaving our output per hour at its lowest since before the financial crisis in 2008. So it's definitely not getting any better since the 2008 crisis. And we are continuing to lag behind our major trading partners in the US, France, and Germany. So you combine all of these economic challenges with the uncertain political environment on both sides of the Atlantic due to Brexit here and the new US administration. Businesses generally are very cautious about investing and are facing across the board increasing costs. And all of this really points to the need to focus on optimizing your compensation spend. We then turn to changes in legislation. Well, pay equity legislation is increasing. We have the gender pay reporting legislation already in play in the UK. And I know from talking to many of our clients, they are looking at allocating portions of their pay budget to address gender pay differentials. But we know that we're going to see further equal pay reporting in the US, and Theresa May here in the UK proposing for more pay transparency on CEO pay differentials and race pay. So, this is going to become an increasing challenge from a cost perspective as companies try and address this as part of their overall pay budget. We've also in the UK had the increase in the national living wage come into effect in April this year. So for those sectors impacted by that, what they'll probably see is an increase of 4.2%, which is the difference between the £7.20 to £7.50 change in the national living wage. And that's going to have an impact on the overall median pay award in these sectors, definitely. We've also had the apprenticeship levy come into place in the UK from April. So for those employers with a pay below over 3 million, this effectively means a 0.5% tax or increase in costs. Again, a further employment cost that's being added to the organisation. And in the US, employers are continuing to monitor predicted changes in FLSA legislation and the impact of costs there, and that's a bit of a moving target at the moment. What all this equates to, this economic, political and legislative challenges, is we're in the position of having to squeeze every ounce out of those limited pay budgets, even before we start focusing on making sure that we pay for those who perform in order to drive productivity. We also need to add into the mix of the challenges that we're facing the question about traditional performance management and performance-related pay models. So there's been a lot of noise around this and people questioning the effectiveness of traditional performance management and ultimately what impact that will need to have on performance-related pay. What is true is that in this digital age, we're really seeing change coming through, changing the way we work and the type of jobs that we do. So we need to probably re-examine the approaches we use for managing performance and reward in line with how the employment relation is changing, the way we work, and how employee expectations are changing. And I'll come back to that point a bit later in this session. So against this challenging background, we have a role in reward to work with our business leaders as business enablers to ensure that every pound or dollar spent on employee compensation is spent wisely. And I'm going to take you through these 5 steps that will hopefully give you some ideas on how to tackle these challenges. So starting with my first step, and I'd encourage you all to actually take a long, hard look at what you're actually paying for. So if we start with salary or fixed pay and talk about pay budget differentiation. Well, pay differentiation, I've already said, is a challenge in a low wage growth environment, and it's often easier to treat a salary budget of 2% as perhaps an inflationary increase across the whole population, often known as the peanut butter approach to salary distribution. I know many of you are also linking salary and merit awards to performance rating and working to some form of bell curve distribution. In my Retaining High Performance webinar back in November, I discussed the bell curve versus Parentian distribution approach and the fact that in reality, the bell curve approach, when used to distribute pay budgets, actually ends up with you focusing the majority of your pay budget on average performers. And you can see this in this one chart I've included from the Mercer US Compensation Planning Survey for 2015-16. But if you look here, you can see the main part of my pay budget is actually going to our middle level performers. So that's not really driving a high performance culture or allocating your pay budget to those who probably should receive it the most. The other area to focus on is, of course, your out of cycle and ad hoc wage increases. I'm sure most of you are doing a check on the total cost of these, and I hope you're then relating that to the real wage increase percentage annually in your organisation. But it's also worth looking behind the numbers at who's actually getting these increases, because if that's left unchecked, then these type of increases can actually destabilise the effectiveness of a well-defined pay for performance system. And there's some recent analysis from a gender perspective that says that employers have shown that more out-of-cycle increases actually go to men than women, because apparently women are less assertive about asking for an increase. And those of you who read any of the commentary in the press in the last couple of weeks in respect of the BBC disclosures on pay would have heard a lot of conversation about that. That is a bit of an open debate, because there have also been other discussions, particularly this recent article in The Guardian in the UK that talked about that potentially that's not the case, that women do ask for pay increases as much as men, but they actually don't receive them. So is there some form of other unconscious bias going on there? Another point to consider is whether you're using a proportion of your pay budget just to pay for tenure rather than paying for anything else. So it is worth running the analysis to look at your average wage increase or pay rates by length of service, and just to check what's going on there. So a few pointers there for having a look at what you're actually paying for from a fixed pay perspective. If we move on to variable pay, if you're using a wholly discretionary approach to bonus allocation, I know this is becoming less common, but you need to do the analysis to see if there is in fact any link to performance or where the money is going and to which groups of employees. Unconscious bias is so much harder to control when pay decisions are very discretionary. For those of you who are using performance rating and a merit matrix approach, as with salary, you need to have a look at where the bulge of your money is going. If it's all going to average performers in the main, then you really need to ratchet up your merit matrix in order to target your high performers. For those of you who are using KPI-based schemes, you need to look at the KPIs you're using and how they relate to individual performance, contribution, and productivity. If you're using a company-wide metric, for example, as a standalone KPI or potentially as a multiplier on individual performance, what this ultimately means is that everybody gets the same award irrespective of individual contribution. And although your payout is in line with company performance, you're not really incentivizing those who contribute most to productivity. And so you need to ask, is this the message that you want to give to employees? Am I maximizing my compensation spend? We're increasingly seeing much more complex bonus schemes coming into play with our clients, with more granular financial measures and non-financial measures for different employees. So my next step, well, I think the message from the last two slides is to take a long, hard look at what you're really paying for. And then on to my second step, which for me is the most critical to the whole pay for performance equation. And that's about how to identify performance and talent in your organisation. So for most of us, reward is focused on paying for performance. But if you don't know what great performance looks like in your organisation, how can you be sure that you're paying for the right things? We also know, as I said earlier, the whole notion of effective performance management is under the microscope, and I'm sure many of you are reviewing practice here. I've talked in webinars before, and some of the articles I've written about the difference between pay for performance and pay for talent. The pay for performance traditionally uses a performance rating to drive compensation decisions, and the focus for me here tends to be on a backward-looking performance for the prior financial year. And I'm encouraging our clients and the people that we work with to think about a more broader pay for talent approach, which looks at balancing both prior year performance with metrics such as future skills, market worth, and attrition risk when it comes to making compensation decisions. And our platform has adapted to be able to support that broader pay for talent approach. When thinking about measuring employee performance in today's world, you also need to consider what performance means in this changing workplace. So what I mean here is old performance-related models traditionally measured employee output. It was all about achieving SMART objectives, and these were most of the time easy to measure. But in our advancing digital age today, more and more effective performance management or talent needs to account for how employees deploy their knowledge and skills to achieve required outcomes, rather than just measuring outcomes. And that's not as easy to measure. So when you're thinking about employee output relative to input and what that means to your organisation, you need to think about where the effort occurs and where does it take place for employees. And what you'll probably find is that varies depending on the work undertaken, and one size definitely doesn't fit all. So this is my point here about employee segmentation. And Daniel Hibbert's book, The Thunder Cloud, which is all about managing pay in the digital age. If you haven't read that, it's a very short book. I definitely recommend you having a read of that. This graphic is from his book, which shows his analysis of different types of jobs and how the ability to differentiate performance and measure performance varies by the type of work undertaken. So what's important here is that you get the conversation going in your own organisation on what performance and talent means for you and how you can recognise, reward and measure that. So once you've looked at performance and talent, then you can start to focus on how to reward that. And when we think about realigning reward, I think there are some key principles to consider. And I suggest you consider each of these principles in turn and test your own reward framework against these and see how you fare. But it's very much about making rational reward decisions that are consistent with the type of organisation you are and the type of markets that you operate in. So a broad brush performance-related pay strategy won't work for all organisations. And it's making sure also that you make appropriate reward decisions or have appropriate reward schemes for the different types of employees in your organisation. And more we know that it's really also about ensuring reward decisions are fair and equitable with minimal compliance and risk, and how important it is to communicate with employees. I'm going to briefly return here to the Daniel Hibbert work that I mentioned earlier from Thundercloud. He has this really interesting full talent model, which I think is a good sort of summary of how you need to think about different types of approaches for different types of organisation and different types of employees. So you need to think about how you manage talent and how that can be the key driving force in how to structure pay. And it will probably hopefully give you some ideas if you're looking for new approaches of what will work for you. So for example, if you take a career type model for managing talent, where there are lots of long-term career opportunities available for those who develop within a career path, then perhaps the most effective way to structure pay is with a pay framework that rewards expertise and progression through the career path. You can contrast that to a market model where you have skills available in the external labour market that you're actually more likely to buy in, and because you may have, maybe a high technology organisation, for example, or a highly skilled organisation where the skills change frequently, and therefore there are limited long-term career opportunities within your organisation. and therefore a single rate of pay aligned to the external market may be more appropriate. And I'll let you, after this session, focus on some of the other suggestions he has. The point here to make is to think creatively outside of traditional performance-related pay approaches and consider what works for your organisation now and in the future. Because one thing's for sure, the pace of change we know in the workplace is unrelenting, and whatever you do in your reward strategy needs to be future-proofed as well. Okay, so on to my fourth step. I've thrown in here the need to look at what's happening beyond cash reward. So I'm talking about intrinsic versus extrinsic reward. So we focus primarily on cash reward so far in the form of salary and bonus, but commentators such as Dan Pink and others have questioned the true power of cash to motivate in today's new working environment, and whether money can actually be more of a dissatisfier from a motivational perspective. I'm sure many of you have read articles or read Dan Pink's commentary on this. I'm not going to delve too deep here because I think it's a topic for another webinar, and I've included a hyperlink in the first bullet to an article where I covered this for the HR Review magazine last year. But if we start to think about how the nature of work and employee expectations are changing and what is really motivating employees, then we can start to tackle employee productivity. I attended the HR Director Summit in Birmingham in January this year and was lucky enough to hear Tammy Erickson speak. She's a big proponent of the fact that work is becoming a matter of discretionary effort, and that to truly engage employees, you need to recognise that employees want to deliver things like extraordinary service, they want to share ideas collaboratively, they want to innovate, they want to gain skills, and they want to have experiences. And for them, that is more important than cash. And this is a different set of expectations than delivering output or achieving objectives. So Tammy talks about how meaning is the new money and how intrinsic reward can be more motivating than extrinsic. And again, I've included the link to her article in the Harvard Business Review if you want to find more about this. However, it's still important that extrinsic needs or money are right, otherwise it will disproportionately crowd out any other efforts that you make on intrinsic reward. And so getting the basics right, the money equation, is really important for your employees. And this is often referred to as the motivation crowding out theory. And lots of commentators have talked about this. I think one of the most compelling facts I heard at the HR Summit in January was that every pound spent on non-cash rewards has 8 times more impact on employee engagement than that spent on cash. So when considering pay, productivity, and doing more with less, it's definitely worth looking at intrinsic reward as part of your reward proposition and having a discussion internally about where that features. So on to my final step, which is to consider how technology can help you on this journey to optimize your compensation spend. Well, whatever approach you choose to manage performance and reward, the reality is that pay decisions made by managers are rarely wholly objective. Ultimately, what it is, it's a decision about people in the organisation, made by people in the organisation, and they're quite often also based on subjective judgments. There are some clear benefits, though, from using technology to support your reward programs. Firstly, automation obviously can make the process simpler and more efficient and give all those participating in the process more time to focus on outcomes and communicate these. But technology can definitely help you with that subjectivity issue. It can help you to calibrate information on employees, and particularly if you focus on using some of the new BI tools, you can provide decision support data to managers. Unfortunately, managers are often not equipped through using spreadsheets with the information to adequately differentiate performance or explain decisions about pay. And technology and HR analytics can help process that information in a more meaningful way. You can ultimately increase transparency with better, smarter pay decisions. At Curo, we've integrated a leading BI tool, and we've launched this decision support tool under the banner of ITCM. And for us, ITCM means it's all about leveraging leading analytical tools to measure and track progress against your strategic reward goals. It's about creating visually persuasive dashboards to empower decision makers and providing powerful benchmarking information. And it's also, as I said earlier, about this pay for talent approach, and enabling you to easily calibrate multiple talent metrics to ensure reward allocation is fair and transparent. And I'm just going to share with you a few screenshots of our ITCN dashboards. So each of our dashboards can be customized to our clients, and each dashboard essentially tells a story for decision makers, and it can give them decision support information around topics such as benchmarking, diversity analysis, and also here in the UK, we're focusing on our clients, providing them with information around gender pay gap. And if you'd like to find any more about ITCN, do get in touch. So what are my takeaways here? Well, hopefully we started with a conversation about understanding really what you're currently paying for, but also making sure you know within your organisation what high performance and talent mean to you, and then making sure that that flows through to your reward programs and your reward principles. I also suggest considering the balance of intrinsic and extrinsic reward so that you can think about overall optimizing compensation spend and maximizing employee engagement in respect of reward. And then I would also obviously encourage you to consider utilizing technology to improve your decision making. So if you want to get in touch, I'll just repeat some of the housekeeping items for those of you that joined later in the call. If you want to submit a question in a minute, you can do that using the chat box at the top of your screen, the Join Me panel. Or if you don't want to do that now, please do email in either to Carol's email or info@CuroComp. The session's being recorded. We'll publish this on our website and probably via LinkedIn. But if you can't find that, then do get in touch and we can provide you with a link to that recording. And if you'd like a copy of the deck, again, please get in touch and we can send you a PowerPoint of that. But right now, I'm going to pause and see if there are any questions from the audience here right now. So if you want to type those questions in, and I can read those and hopefully respond to you. Okay, I had a couple of questions earlier. One was on that pay for talent approach, and people asking what type of metrics people are using. So if they're moving away from pay for performance to pay for talent. Well, I've been working with a couple of US-based organisations, and what they're very much focusing on is output from talent assessment, so from their 9-box grid approach. And they're also using an attrition rating for all employees. So they have a 3-rating scale from an attrition risk perspective, so rating how important it would be if each person left the organisation. And what we're able to do in our solution through the pay for talent approach is to be able to calibrate both performance rating, the talent grid outcomes, and the attrition risk outcomes in order to rebuild, for example, the merit matrix and the recommended pay awards for individuals based on those broader range of metrics. Any other questions at this stage? Okay, great. Well, I'll thank you all for joining us this afternoon. I think we have another webinar. We have another couple of webinars coming up this month, and we're working on the assumption that not everybody is on holiday in August. So please do join one of our other webinars. And if you have any questions about today or our solution, do get in touch. Thanks very much.